Good morning, everyone. Thanks for joining us. This is ING Bank Śląski webinar on the Eurozone economy. Let's give 1-2 minutes for other clients to join. We have plenty of them just logging in, so let's wait 1-2 minutes for others. We're very pleased to have high number of clients joining to our meeting. But let's spend a few minutes more waiting for others. I still see number of participants is growing quite rapidly, so let's wait a few more minutes, 1 more minutes before we start. Okay, so let me start officially. Again, this is ING Bank Śląski webinar on the Eurozone economy. I'm Rafał Benecki, Chief Economist of ING Śląski in Poland. I'm very pleased to host today webinar with Karsten Brzeski, our Global Head of Macro Research in ING Group. During today's webinar, we want to present our outlook on the Eurozone economy. This is our first macro webinar this year. The reason we decided to start with this theme is that 2021 GDP recovery in Poland should strongly rely on export. In our forecast, we see strong GDP recovery of 4.5% in our economy, driven by two factors, local consumption and export. This is why we invited my colleague, Karsten, to update us on the outlook for the Polish main trading partner. I strongly encourage our clients to ask questions on our chat. We will try to address them after the presentation. I also invite you to our next webinar, which should take place on the 19th February, which is next week on Friday. During that webinar, we'll present our view on Poland. So I really encourage you to join us on the 19th February as well. At the beginning of January, we posted our 2021 yearly outlook, where we presented strong GDP recovery and above consensus CPI for Poland. So we want to update you through our updated forecast on 19th on Poland. Today, Eurozone is focused. Karsten, please take the stage.
Thank you, Rafał. Thanks for the invitation. Let me just take over the presentation here. It's an honor actually to be there, and as you all see from my last name, it is Polish. But apologies that I only speak very few Polish words, being from Berlin originally. But so I rather stick to English. So what I'm going to talk about for I think 30 minutes is our European outlook. I'll talk a little bit about the economy. I'll talk about the ECB. I will also talk about more structural topics, and then I really hope for some nice interaction, because I think this is what is let's say the most fun part, to interact and to really address your questions afterwards. So let me start, and listening to Rafał and the Polish outlook, we were, I think, more optimistic a month ago on Europe than we're currently, because somehow, as so often, you think everything is fine with Europe. You actually think that nice, so finally they got their act together. Finally they are moving. And when you look at 2020, we had, there was so much credit for Europe tackling the crisis, unknown fiscal stimulus. In the summer, we had European solidarity with this European Recovery Fund. Okay, it took a while, but we also got there. We had an ECB strongly in the market. And all of a sudden, we think, yes, that's the moment. Europe should lead the global recovery. Now, being early February, I think we're gradually changing our mind, and we see, damn, what is it? It is the virus is still there. Europe is the only region which is going through a fully fledged second lockdown wave or round. The vaccination is clearly stuttering. It's not really gaining momentum. Other regions, other countries are clearly more advanced in terms of vaccinations. So we're gradually postponing the moment of our recovery scenario. But I will tell you more about, is this also a reason then to really give up on Europe? I personally would never. And I think we will see this recovery. Also in the bottom line of this presentation, we will see the recovery. It will come a bit later, and it will probably not be as strong as what we're going to see in the US. Now, that is more the bottom line. When you look at where we are right now, and just show you some nice Google search and Google Analytics, we still talk about the vaccine. We still talk about Corona. This is still vaccinomics, if you want. Yeah, and I'll just throw in some charts. I will not address all the details there. What is the main message from this one here is we are in the second lockdown wave. We see that the number of new infections has come down already, but and I just saw the news alert on my smartphone on Germany, where the German government is today discussing on what to do with the lockdown measures. The German lockdown measures were supposed to last until the 14th of February. Now we have talks that they might be extended by another 4 weeks. And how come? If you look at these numbers, it cannot be the new infections because they are coming down, but it is the mutants. And the mutants do not come from kind of a horror movie, some B or C Hollywood movies, but the mutants come from Britain, from the UK, from South Africa, and also from Brazil. And there is the fear currently, and there's still more fear, that these variants spread faster, that they are more contagious. And this, in my view, is the reason why we'll see more European governments, if not all, actually extending the current lockdown measures. In our underlying assumption, our base case scenario, we always said, we assume the lockdowns to last until the end of February and then to start very gradually in easing off the lockdown measures. When I see what the German government apparently is discussing today, what I see what the Dutch government announced earlier this week, I'm a bit afraid that we will have to postpone this again. And this looks more that the lockdown measures will at least last until mid-March. In the worst case scenario, even until early April. And this then automatically pushes forward the profile for any recovery. We had hoped for that we would see, okay, yes, we knew that the lockdowns would continue, but we always had hope that there would be more vaccination momentum. And to tell you the truth there, we don't have it. Probably all of you have become kind of hobby virologists right now, vaccination experts. Point is that especially the US, especially the UK, and then when you look at Israel, these are the three main blocks in which the vaccination speed is much faster. Well, you probably also follow the news. There is a lot of blame gaming currently. Well,
I think there are problems with hearing Karsten. So so let's let Karsten to maybe refresh his connection. Karsten, maybe if you can restart your connection. So in the meantime, let me comment the current slide. So Karsten just said about vaccination that it's slowed in Europe, and Europe is lagging behind UK and US. So so this is the current state in terms of percentage of population which was vaccinated. It is almost 60% in Israel, 13 in UK, US, and close to 3.8 in Europe and 4 in Poland. So that's the numbers. Karsten, we cannot still hear you. So maybe let me continue with a few words. We do think that the vaccination should speed up in coming weeks, especially from March onwards. It is actually Pfizer, the one of the biggest producer who re-engineered his factory in Belgium, and that factory should start producing a higher supply of the vaccine just in coming weeks. So in March, definitely the vaccination should speed up in Europe. That's first important conclusion. The second one is actually that Johnson & Johnson vaccine is also coming. Globally, it is really... Okay, Karsten, we have you back. So
you have me back? Okay, this is very nice.
I just said that.
Yeah, hold on. So, yeah, okay. So just give me a thumbs up, Rafa, if you can hear me now.
Yeah, I can hear you. I just said that vaccination should speed up from March onwards because of the Pfizer, because of Johnson & Johnson. So please take the stage again.
Yeah. Okay. Thanks. And my apologies. I think this is a sign. When I come to the structural issues, that I'm living in a country which is really in desperate need for more investment in digital infrastructure, because our digitalization and high internet speed in Germany, bluntly put, sucks. So thanks, Rafa, for taking over and talking about the vaccines. So what I was showing there, and just to add on Rafa, is that Europe, spread its odds, and that there is now, I think, the reason to look beyond the short-term noise, look beyond the weekly noise. Will they be able to deliver or not? Because when you look at the underlying story, and I heard Rafa also talking about Johnson & Johnson, there are more and more producers. We also have, for example, BioNTech, upon political pressure from the German government, which is clearly stepping up its production. And we see that a couple of these producers are now going into other factories. BioNTech, for example, took over the production facility of Novartis in Germany. It only took them 40 days, and now today they started to produce in this new facility. So there are still good odds to think that that Europe will be able to speed up the vaccination process. What we're currently assuming is that Europe will not be able to catch up with the US and the UK. When we look at estimates for when will they reach herd immunity, it is in the US and the UK the summer. We talk about July, August. And when you look at then Europe, we will only reach herd immunity, that is between 60 and 70% of the population vaccinated. We would reach that in October. And then clearly, this is also having an enormous impact on our economic scenario because it is very closely linked. Let me just then go on to more in-depth knowledge about the European economy. When you look at this, I'm just showing you that we have this very close connection or relation between the lockdowns, the severity of the lockdown measures, and economic development. Obviously, reducing mobility reduces the economic performance. And what we see here in that the second lockdown wave was much milder than the first lockdown wave. This has to do with, I think, two important factors. Factor one is that in the first lockdown wave, all people were much more scared than in the second lockdown wave. So we saw a much bigger chunk or degree of voluntary social distancing. The other factor is that in the first lockdown wave, we saw a combination of supply side and demand side shocks. So factories, the industry, also closed their doors. And that was not upon the pressure by the governments, but that was more or less voluntarily. And why is that? As we all know, there were supply chain disruptions coming out of Asia, the entire world closing down. So there were very, very few reasons for the manufacturing sector, for the industrial production sector to continue. This is different, or this has been different so far in the second lockdown sector, which explains why in the fourth quarter, we saw economies like the German economy, which with a much bigger or more important manufacturing sector, doing better than economies with a larger service sector. Because industrial production has continued. And what is the reason? The reason is that we still have this V-shaped recovery in China, and that we didn't have a really fully fledged second lockdown in the US. This has helped really keeping the manufacturing sector afloat. That is an important factor. Now, does it make sense to put any growth numbers on it right now? Not really. We had the contraction in the fourth quarter, milder than some had expected. When I just look at what I just mentioned, the expected duration of the lockdown measures, going until the end of February, maybe even further, it is very easy to forecast that we will have another contraction of the Eurozone economy in the first quarter. Only afterwards, we will see the pickup in growth. Here, what I'm showing here is clearly this decoupling of the manufacturing sector. And this has actually happened since the summer period. And it benefits the economies that have a stronger manufacturing sector, and it benefits the economies which are more export-oriented. Germany, Italy, clearly decoupling. Is this something, is this something that is sustainable? I personally have my doubts about it. But this is also the nice thing of the current economic analysis. You need to make a distinction between what I would call the cycle and the structure. And the cycle means manufacturing sector will be a growth driver. Does this mean that the manufacturing sector will structurally be an important growth driver? You can have some doubts about it. I will touch upon this in a second. But when you look at the manufacturing sector, don't forget that the manufacturing sector in the entire Eurozone had been on a downward slope since summer 2018. So the manufacturing sector entered the crisis on a much weaker footing than the service sector, which makes it easier to grow again, but growth does not necessarily mean that everything is fine. Let's go to the next slide here. Yeah. So when we also try to come up with our growth forecast, we say, okay, manufacturing sector short run, a plus. What about private consumption? You hear lots of stories, and also when you listen to stories about the US, that we've seen an enormous increase in savings. What people make a distinction between involuntary savings, because people are at home and cannot spend, and the other one are precautionary savings. People are afraid that they could lose their jobs, so therefore they save more. But fact is, savings have gone up a lot. Does this now mean, once the economy opens again, that we will see enormous pent-up demand and consumption growth? Well, this is what happened in the third quarter. Now you see the savings rate going up in the second quarter, and then economies open up again, bang, lots of consumption. I have my doubts that this is going to repeat itself now in 2021. To some extent, but clearly not to the same extent. And why is that? This is because when you try to dig into these savings rates, you will see that it is not everyone who can save more, but it is very often the higher income households which are able to save more. It is not the lower income ratios. In fact, and I'll show you here in an ING survey, when you look at the European countries, we have approximately 1/4 to 1/3 of the population saying that they are not able to save at all. So this means the increase in the savings ratios mainly comes on the account of the higher income households. These higher income households have a much, technical term, a much lower propensity to consume. What do I mean by that? It simply means, it is the better off, the higher income ratios, and they will they spend more once the stores go open again? Probably not. They might spend more for their summer vacation if they're allowed to go out. But we will not have this imminent spending impulse. So therefore, private consumption will grow, but it will take a while before we actually, return to pre-crisis levels. What is positive when you look at the European economy here is fiscal stimulus. Still by no means comparable to the US, because what most governments did is they gave out more loans and guarantees, trying to put a floor under the economy, while the US has given out under Trump more or less in-the-face fiscal stimulus. So these are the grants. These are the $600 checks being sent out. There's only one country in Europe which has done similar things or comparable size, which is Germany. So roughly speaking, the US has given out some 10% of its GDP on really in-your-face fiscal stimulus. Germany ranges somewhere between 8 and 10%. The only problem with Germany is these numbers look extremely impressive on paper. Unfortunately, when you dig underneath, hardly anything has really been spent. The money has hardly reached the people. Income substitution hasn't reached the people. The investments announced last year haven't reached the economy. So of this 8%, 10% fiscal stimulus in Germany, only roughly speaking, 1/3 has so far reached the economy. But in general, when I take a longer term look at the European economy, I find this positive, because in my view, this is not only a one-off, but it shows us that we will have more active, stimulating fiscal policies over the next couple of years. Because what is interesting here is that this fiscal stimulus is not completely the stimulus that we had, 10, 20, 30 years ago, short-term oriented, but it is a combination. It's a combination of short-term wage subsidies in the form of these short-time work schemes, for example, but it's also 1/3 of all fiscal stimulus packages go into longer-term projects: investment, sustainability, digitalization, fight against climate change. So this is something that could, in the longer run, also improve the growth on, let's say, the natural growth rate of the European economy. I say it could, because it obviously is highly important that the money is spent. So that it's not only an announcement, but that the money is really spent. Now, the other thing is the ECB. As we all know, extremely cheap liquidity for the banks. We also know extremely cheap or low interest rates. And it is not only that, it took Madame Lagarde a little bit last year in March to understand the situation. Came at the cost of a small financial market turmoil, especially when you look at spreads. But they got their act together, and with the new asset purchase program, with cheap liquidity for banks, the ECB has now more or less also put a kind of constant level of monetary policy accommodation in the Eurozone. If you want, we can discuss later, whether this makes sense and about the adverse effects, etc., etc. But just from an ECB's point of view, they know that this crisis is not a crisis for the central bank to solve. What the central bank can do here is avoid financial market turmoil, like we had in March. The ECB can also try to avoid a new euro crisis from emerging. Well, I think they first said it, but then afterwards they tackled it with this asset purchasing program by keeping the spreads between government bond yields very narrow. This is what the ECB can do, and flood the economy with cheap liquidity. Because the European economy is still to some 70 to 80% depending on banks. So this is what the ECB can do. Would let's say making liquidity even cheaper have an added value? I doubt it. Would pushing interest rates even lower have an added effect on the economy? No, I doubt it. So this is why the ECB is now just keeping this level of monetary policy accommodation unchanged until at least March next year. And they hope that all these virologists are right, that we will see a lifting of the lockdown measures, that we will reach herd immunity at least before the end of this year. And if all of this happens, then the ECB does not have to intervene anymore. Then we would rather have a situation by the end of this year in which we will talk about some withdrawing of this monetary policy stimulus. Doesn't mean rate hikes, but it will just mean the gossip, the speculation on how ever to get out of these ultra loose monetary policies. We will just in a second. So this also underneath all this. So we still have some consumption going on. We have an enormous shift towards online. If I have to summarize just our economic profile, like Rafa said on the Polish economy, so contraction in the first quarter, easing of the lockdown measures at least at the start of the second quarter, and immediately a pickup of growth, with the underlying assumption that Europe will reach herd immunity at the end of the third quarter, early fourth quarter. We will see more momentum, and then finally the European economy taking off. In terms of growth figures, I'm always a bit hesitant because this can change so often. But we're now penciling in, let's say, at least sub 4%, so something like 3.5% for the Eurozone for this year, and a bit of an acceleration towards 4% in 2022. With this scenario in mind, it would still take until 2023 before the Eurozone as a whole will have reached herd immunity, will have reached the pre-crisis level. That is important to know. What is also important to know is that the differences across the European countries will remain, and they probably will even get bigger, because a country like Germany in our current profile would reach pre-crisis levels at the end of this year, early next year. Yeah. and other countries like Spain, like Italy, they will take until late 2023 before they will reach pre-crisis levels. What also means in this political post-Brexit discussion, the risk of a Eurozone crisis coming back is always there. Which form it will take, I don't know. Will it become a real pressing issue? Probably not, because when I look at Europe, at the European politics right now, we will be in a standstill but from this summer onwards to the next summer. Why is that? Because the two largest economies are going to have elections. Germany end of September, France next year, and we all know that, you know, between these two elections, nothing will happen at the European level, or at least nothing significant will happen. But I think that is always something to keep in mind, that the risk of a Eurozone crisis will always be there. We just jump, because due to our technical problems, we lost some time, and I really want to hear your questions. Just 5 topics I also wanted to bring across, which are more structural. One, probably the hottest topic right now, inflation. So Rafa said Polish inflation revised upwards. We did the same at the start of the year for the European inflation. And when you look at financial markets, the return of inflation is clearly the main theme. It is an even bigger theme in the US, where we currently foresee inflation to come in at 3%, 3.5%. Others are even saying it could even be more. I don't know whether you followed this US discussion between Larry Summers and Blanchard about, you know, so much fiscal stimulus in the US leading to a very quick overheating. We do not agree. I think we rather stick to Janet Yellen, who last weekend said that even with the Biden stimulus, it would still take until 2022 before the US labor market has returned to pre-crisis levels. So this is not overheating in the short run. But when I look at Europe, and that's the more interesting thing for you, we now have so many technical one-off factors which will push up inflation. This is one, the reversal of the VAT reduction we had in Germany. So we're now back at 19%. This is something that will play out mainly in the second half of this year, because remember, the VAT reduction was from July to December 2020. We have higher energy prices, especially now in the upcoming month compared with 2020. And we will also see some, at least, pockets of inflation once the economies open up again. And this is what I would call then the reversal of social distancing deflation. Last year with social distancing, we had that all of a sudden prices were not available, that in the leisure industry and restaurants prices were rather dropping. We will now see with the opening up of the economies, there will be these pockets. Very attractive vacation destinations, they will go up in prices. A restaurant around the corner finally opening up again is very likely to, at least in the first weeks, do a bit of a price markup. So, but this is only a 2021 story. So a higher inflation is only a 2021 story, because these factors will peter out. And this is why we then think when you look beyond 2021, what is really determining inflation? Let's leave aside asset price inflation. What is consumer price inflation? It is driven by the bigger macro story, and I'm lacking the fantasy and the creativity to see that an economy which will reach pre-crisis levels, but only in 2023, an economy in which several sectors are still facing bankruptcies, an increase in unemployment this year, that this economy could really produce a sustainable wage price spiral that we know from the textbooks. I don't see how employees have any pricing power, how they can ask higher wages in the next years. So this means there could be, like this year, increase in headline inflation, but this is not a sustainable return of inflation. Instead, we currently say Eurozone inflation could go to 2% this year, maybe even above. But next year will drop again to something like between 1 and 1.5%. Is this an issue for central banks? Obviously, it's an issue for central banks. It is an even more pressing issue for the Fed, because we will see that there will be a collision or a clash between central bank communication and what financial markets expect. We all know the reflex by financial markets. If they see inflation going up, if they read about stronger growth numbers, they will start to price this in bond deals and in longer-term interest rates. It will then be up to the central bank to communicate, oh, no, guys, this is not what we're going to do. We're going to look through it. We keep interest rates unchanged. And this is clearly a very interesting clash, even more interesting in the US than in the Eurozone, because in the Eurozone, I would always argue in the end, interest rates or bond yields are simply the result of supply and demand. And as long as the demand is completely absorbed by the ECB, there is very little room for an increase in long-term interest rates. But this is clearly a very, very interesting story. Digital transformation. My home country really needs a lot of this digital transformation. You can look at it from both sides. Corona being an accelerator of this digital transformation, a wake-up call, or just another alert, and we will never make it. What we will see, in my view, what I talked about, all these fiscal stimulus packages, is that Europe has waken up, and that we will see this investment going into the digital transformation. And this is not a call only for governments to invest, but this is also a call for governments to create the incentives and the framework for the private sector to invest. Because we all know that, as much as economists love to talk about governments and fiscal policy, in the end, it is the companies, it is private investment, which will have to push the economy along. I'm currently taking a more positive stance here and say, yes, this is finally the wake-up call for Europe to get its act together. Behavioral changes are very hard, and this is something you will think about yourself. So this is more a shift towards working from home, like most of us have been doing for almost a year now. This will have an impact on real estate prices. This will have an impact on at least commercial real estate prices. We will also see that some sectors, will probably take much longer to recover. Just to think of the travel industry, leisure, even restaurants, culture. So they will take years to recover from this crisis. While at the same time, you could argue the industry is still doing relatively fine. We will also see things like moving away from urbanization towards moving out to the rural areas again. So there will be enormous shifts in countries, in societies. Also for Poland, and I think a very interesting thing is, will we see now an extension of this trend towards nationalism, towards protectionism, or has this stopped? And this is very interesting because there is no single one answer to it. But over the last years, with Brexit, with Trump, we all have been saying, gosh, this is protectionism and we will never return to free trade. You could argue that this crisis now is actually accelerating this trend, because when you just look what happened at Europe, that we thought that we could stop the virus at the borders, that we stopped or that we made some escape clauses to the Schengen agreements. So it's very easy to say this will continue. I doubt it, because I think life is not that easy. And I think that despite all the chaos that we have right now, that Europe will try to work together more closely. I also do not see a lot of repatriation or renationalization of industrial production, in all honesty, because at least when I talk to corporate clients, they always answer, this is just a naive economist's idea, because have you ever thought about how expensive it is to bring an entire production facility out of Asia back to Europe? And so therefore, this will not be that easy. What you could see is that in this entire age of digital transformation, sustainability, fight against climate change, that we will see more jobs popping up in R&D in Europe again. So that the jobs with higher added values will either return to Europe or will stay in Europe. That is something that I could definitely see. And this is more about the structural change, as I'm running out of time. So I will just, the final point here, and I will not even show you the fifth one. To me, this decade is about fiscal stimulus. This is no more about central banks. It is the Japanification of Europe. We talked about this before the crisis, and we will continue talking about this after the crisis. And why is that? Two reasons. Reason one, this enormous need for investments. Like I said, transformation, we know the story. But the other one is, and that is something I'm showing there, the other one is social inequality. This crisis will have accelerated social inequality. And how can governments react on social inequality? By redistribution. So you can either hope that the cake will grow larger, not really unlikely, or you will start with redistribution. And redistribution is another reason why we will see government debt increase. And this is another reason why we'll see fiscal stimulus being, in my view, the most preferred economic policy instrument of the next decade. And I'll stop here, and I will hand over to Rafael, and hope that we can still have another almost 20 minutes of a nice discussion. Thanks for your attention.
Thank you very much, Carsten. I do encourage our clients to ask questions via our chat. So let me start with the first question. Maybe let's try to discuss a little bit the issue around Brexit. So in the short run, we saw in the Eurozone GDP that stockpiling before the Brexit supported German export, and we have seen a bit better GDP performance before end of the year. But this is short-term story. What do you see in discussion with German companies, with Eurozone companies you met online, of course? How they see the business down the road after the Brexit?
The funny thing is, also when I talk to our colleague in London, he always says that the British companies were still not prepared for Brexit, and they were still taken by surprise. When I had been talking to German clients, at least over the last 2 years, they were hardly interested in Brexit and said, we are fully prepared. And then it depended on the company, on the sector. So were they doing business with the UK, or were they in the UK themselves? But they had done all the preparations. So in my view, also for the growth forecast, so you need to make a distinction. So is it, for example, a big retail company which simply does business in the UK? The only problem for them is the short-term disruptions at the borders. But they were prepared. Will it go completely unnoticed? No, it won't. But this should really only be of an impact in the first quarter. That's it. Other companies, I won't mention any names, but think of automotives, which sometimes send parts of the assembly line back and forth 5 times across the border. They also changed more or less their production processes, so to have less of an impact. So therefore, I think for as arrogant as it might sound, for continental European economies, Brexit is not the big issue. It is rather an issue still for the UK. The UK also needs to show that anything they will export out of the UK to continental Europe has the UK or the EU brand on it. So, another, maybe a Japanese automotive company will have more problems because they will have to show that they are actually UK manufactured to still be able to enter the continental European market. If they can't, so if there is only a very small added value production in the UK, such a car would no longer have the UK or the EU brand. So to me, it's really the economic impact will be felt now in the first quarter in the Netherlands, in Belgium, because they have the port, they have the border. We will not feel it in Germany, despite whatever the reversal of stockpiling, but it will have an enormous impact on the UK economy. When you do these forecasts, as you know, it is currently extremely hard to disentangle, as Corona and lockdowns have such a bigger magnitude than the impact of Brexit. You know, remember, and you know that, Raphael, that I think at the start of Brexit we did some estimates, and we said, okay, even a no-deal Brexit would cost the European economy something like 0.2 to 0.4 percentage points of GDP growth. Well, in the current bigger schemes of things, who cares about 0.2 or 0.4? No one really. Yeah, so this is, I think that is to me the conclusion on Brexit. And obviously, don't forget, we still have financial services not covered at all in this light trade deal, and that is something that is of, first of all, enormous importance to the British economy, but also to the European economy. And this still remains, I think, tough negotiations in Brussels.
Okay, thank you for that answer. So let's return to the discussion of nearshoring you addressed before end of your presentation. So Polish authorities, but also Polish companies, Polish business is hoping for that some part of the activity may be moved near borders. So maybe from Asia to Eastern and Central Europe, which is Poland. How do you see? What do you see in discussion with German companies? What was their plans? You said about R&D will be closer, definitely, but other activities maybe should stay in Asia because of the cost. But let me present the question our client asked.
Yeah.
And someone said maybe automatization and digitalization should help contain higher costs and let some of the production move back to the Europe. So in other words, maybe at some point we will see more activity and production back in Europe, but ultra digitalized and automated in facilities where labor costs are really scarce. What do you think about that? Maybe can you share with us?
Yeah. I saw the question in the chat as well. I would agree. Let me just, as a good economist, I'll give you a broad answer. In my view, and I think that is also shared by many German corporates, the Asian Pacific region is the big growth region of the next years. This is China having a strategy of becoming the largest economy by 2030, also becoming what they call a fully developed economy by 2030. Then they use GDP per capita ratios, but which means that if they were to reach that goal, they would have to grow by something like 4 or 5% every single year for the next 10 years. When you look at this trade agreement that was reached at the end of last year in the Asian Pacific regions, China, Japan, Australia, and a couple of more. It also, to me, shows that this is really another power shift of the economic centers globally. And with this in mind, I don't see many corporates, repatriating their production out of Asia to Europe. I think that so we won't see any changes there. But what we could see is the R&D story, the automation and digitalization story, that also given the incentives that governments will create domestically, that we will see more investment, that we will see more R&D activities, that we will see more innovation, returning to closer home, to headquarters, and that this will clearly have an impact on Europe. It does. The only thing is that normally this will not go hand in hand with a lot of employment growth, because when you look at it, this will be much lesser jobs than you would have in the ordinary production, but it will be much more or jobs with a higher quality and a higher level of education. So I think this is clearly what we're going to see in the now in the coming years. And then the other thing where could you see some repatriation is clearly in strategically important sectors, because that is because this is where then politics clash with business. That while the business would say, hey, but Asia is our growth market, we now have more European initiatives actually to move along with the US and be much more critical vis-a-vis China, be much more defensive when it comes to possible takeovers from Chinese investors of European economies. So this is a very interesting playing field. So because Europe is so depending on exports to both Asia and the US, but at the same time they want to become a bit more protectionist. This is a long answer. Short answer would be, so don't expect so much repatriation as you currently hear, but expect more of the high quality jobs staying or maybe even growing in Europe.
Okay, thank you very much for that answer. So let's maybe touch upon some financial market issues. So what is ING House view on euro-dollar? We see recently that the strong consensus for further gains of euro-dollar is to some extent weakening. So there is slowdown in vaccination, and we have seen a rather range-bound euro-dollar. What do you think would happen in next months when vaccination will speed up?
Well, I think you and I, we both know that predicting exchange rates is, I think, one of the worst thing economists are asked to do. Predicting economic growth is already tough, and interest rates is tough, but exchange rate is even tougher. At the start of the year, we clearly had this view of a nicely synchronized global recovery in the second half of this year. All regions going up. And we know from the past that these situations go always hand in hand with a weaker dollar. So this is also why we had a stronger euro, but mainly a weaker dollar, and the euro dollar going to 130 by the end of the year. Now with the disruptions, the problems in Europe, we also, when I mentioned these dates for when will the regions reach herd immunity, I didn't mention Asian countries. But when you look at Asia, most Asian countries haven't received any vaccination so far. So they will reach herd immunity only in 2022 at the earliest. So which means that this picture of this nicely orchestrated global recovery is getting some cracks. And with these cracks, I think we will also see that we will become more cautious with our exchange rate outlook. We haven't changed it so far, but I would not be surprised if with our next, let's say, monthly economic outlook, which will come in March, that we become a bit more cautious. Because why is that? Even if Europe gains momentum, we will see that the interest rate differential or difference will rather increase on behalf of the US. So what I mean, when you look at that interest rates on the back of this fiscal stimulus inflation story, there is a higher risk, or there's a risk that US yields will increase much more than European yields, and then this makes, I think, something. What I could rather imagine is something like a bandwidth, yeah, that we say we will probably stay between 120, 125, or even 115, 125. But this nice story of a continuing weakness of the dollar is a bit tougher to sell these days.
Okay, thank you. So let's address another question, which is important in planning at the corporate level. When do you think ECB may start hiking rates? This is very important assumption for rates forecast in Poland. We know that Polish Central Bank is referring to ECB. So when first hike of ECB may happen?
Would I say never? No, I wouldn't. 2023, to give a very short answer. I expect it will always take longer than we think. I expect a discussion at the ECB in the second half of this year, more to the end of this year, similar to what we had in 2019. Namely, okay, economy is going up again. We are clearly not in a deflationary scenario. So how can we on earth get out of these extremely loose monetary policies? But they will never rush things. So the first step they will do is unwind QE. So this means by the end of the year, announce that they will not extend the QE program for the pandemic. So that they will continue purchasing bonds, but at a much lower pace. And this will continue throughout 2022. I could see a situation in which in the course of 2022, we will see them considering to hike the deposit rate, yeah, from minus 0.5 maybe to minus 0.4, minus 0.25. But this still would not imply a hike of the policy of the refi rate. So first they would get more or less the bandwidth a bit smaller, and then end of 2022 talk about the first the first hike of the refi rate. And when will it happen? I would currently put it to 2023. You also know, making a bit fun of economists. If an economist tells you on what is it, the 10th of February 2021 that the ECB will hike in 2023, it only means he doesn't know.
Okay, so bottom line is the next hike in Europe is really far away. So we can assume that rates in Poland will stay low at least until end of the current term of the current MPC, yes, which is middle of 22, if not longer.
Exactly.
Okay. There is a question on the real estate. Maybe you can share some flavor from the German market. I mean, the question is whether real estate. I mean, whether real estate will produce lower yields due to the many investors looking for yields, or in opposite, maybe the prices will decrease because of the lower demand for office space and more often home office. So what do you think about that?
Yeah, no, hard to come up with a general answer because markets differ, as you know, and I'm in no situation to talk about the Polish market. You know much more about it than I do. In general, what you would expect is clearly pressure on office space. This is because no, we will not all continue working from home, but more of us will. So there will be less demand for office space, and I could really see prices going down. It will then depend on on governments, on bureaucracy, whether a country will allow this office space to actually be refurbished for residential properties. And this also differs across European countries, because you know that actually in all bigger European cities, there clearly is still a lack of supply of residential property. So this could mean some refurbishing. Office space means prices will clearly go down. And when the question on lowering of rent, listen, I think really this will at least this at least take 5 years, with still the aftermath of Corona, with keeping distances, allowing employees to work from home if they want, and then we will get the next wave. But this is, everything comes in waves. Whether it is the office space without an own office, whether it is the return to having own offices. So, but the next 5 years will still be determined, at least in this segment, from Corona. There will be maybe a little bit of a push towards having more square meters per employee, social distancing, but in general, a clear drop in demand for commercial real estate. And then, final word there, and this is one just from the employee's point of view. The other thing, of course, is to just think of commercial property like shopping malls, big movie theaters. So these other sectors, and they will clearly also come under pressure. So it is hard to see. You might argue, okay, maybe a commercial property like running a huge whatever data storage, or storages for online delivery stores. These things will clearly pop up more, but the traditional commercial property like offices, like shopping malls, they will continue to suffer from the post-Corona.
Okay, so thank you very much for this question. Maybe at the end, a kind of tough question, which I will try to answer. So we have a question: what Polish banks are doing to support investment in Poland? And so I'll try to address that. So first of all, we see that really investment are lagging in Poland in the last few years, especially private investment. We try to understand, we run many researches to understand why private investment are lagging behind. So first of all, we see that SME sector is really suffering from tightening of the tax policy and regulatory risk. So this is the first place where investments are weaker. Number two, the scarcity of labor. This is another explanation why investments are weak in the last few years. So Polish business model, Polish economy model was very extensive. So usually more people and more investment were coming together. We are in the situation where we reached almost natural unemployment, of course, before the COVID. So that was actually constraining investment growth in the previous model. So that's the answer number two. What Polish banks are doing to encourage investment? I can only say ING Śląski in the last few years really expanded in balance sheet by credit expansion. Before COVID, we were among those banks who were outperforming the sector with supply of credit. So we think we were among leaders of credit creation in the pre-COVID era. That's I think the answer we can give to this question. I cannot see any other questions. So thank you very much for all the participants. Carsten, thanks for your view. I do encourage to participate in our next webinar on 19th February on the Polish economy. I also want to let you know that you will receive Carsten's slides automatically from our distribution system just after the webinar. Thank you very much. Hope to see you again. Have a nice day.